Here to tell us why, Lauren Goodwin, Chief Market Strategist for New York Life Investments. Okay, the market's gotten a lot more broad. That's like one of the last things the bears wanted to see because it chops further at their story. And eventually you keep chopping away at the story, the tree falls. Are you not on the page of the bulls yet?
I want to clarify where I'm a bear.
Okay. Cool. I mean, could you admit it? Come on. You have to admit, you've been pretty cautious, if not negative, on the equity market. Fair?
I don't think that that's fair, actually. I've been very cautious on the U.S. economy. And there we can talk about all kinds of risks or risks to that view.
Okay.
But when it comes to being invested, we've actually been very constructive, even on mega cap tech, which is a lot of where the conversation is played out. And I've been talking about how to play all different sides of, for example, the NASDAQ story that we're seeing today and the broadening market rally. And so actually, if I look at the risks to the rally, it's all kinds of things I don't see likely to happen in the next couple of weeks, maybe even the next couple of months. So we're staying fully invested.
You are. I mean, I wouldn't describe you, though, as somebody who comes on the program and is bullish U.S. stocks. I don't think you've been bullish U.S. stocks.
That's fair. We haven't been chomping at the bit, and a lot of that has to do with being, tactical for us is 6-month moves, and so that's you have to move carefully, slowly, thoughtfully, whatever the case may be. But when I look at this rally and the broadening that we've seen this month that you've pointed out, and I say, how could that broaden further? There's a couple things that we would need to see. Earnings broaden further from here. We're not likely to see that in the next couple of months, right? We're wrapping up on earnings season.
And they've been better than expected.
Better than expected. You'd also like to see rates expectations move back lower. And so really, though I think we've probably been saying it for 3 years, we being all of us, is that this market all comes down to not just rates, but expectations of rates. And that comes down to inflation.
Yeah, but okay, so no big surprise in PCE. And the expectation still exists that the Fed's going to cut. And maybe we don't care as much today as we did yesterday, so to speak, on how much and when it starts. We know it's coming. And that's all that matters.
That is all that matters. And I think that's one of the reasons that investors should be making the most allocation shifts right now. And some of those things we've talked quite a bit about, moving cash off the sidelines into bonds. The move that we saw in terms of bond performance at the end of last year, we've only seen the beginning of it when the Fed starts actually cutting rates. There is still so much caution, so much cash on the sidelines that can move in this market. And so we're choosing to be a bit early on that front, moving into short duration credit and municipal bonds as a starting point.
Okay, so why do you favor taking cash off the sidelines and putting it into bonds rather than stocks? It feels like your favored position is into credit. Not into equities, from cash.
From cash into credit, because when the Fed starts cutting rates, and especially if the Fed's cutting rates faster than the market expects, it'll be because growth is slowing. And in our view, that favors credit not only from a risk-adjusted basis, but also because part of the reason to move from cash into credit as the Fed cuts rates is because you're trying to lock in higher yields that we have right now.
Sure, well, yeah, of course, because you think then yields are going to come down considerably. But you still, I get a sense, think that the Fed is not going to cut necessarily for the right reason. You think they're going to be forced to cut because the economy is going to weaken more than people maybe think today it will. Is that fair?
I think that's fair. I hope that the Fed starts cutting for the right reasons, that they've seen that their policy is starting to take the impact that they thought it would take. Inflation's coming down, which I do expect will continue to be the case. That this inflation risk that we've seen near term is just a temporary blip in the data, part of the disinflationary process. But my expectation is that as we move throughout the year, growth is still liable to slow, and that the Fed will actually cut more assertively than the market expects right now. And frankly, at least for the next few months, bad news in the economy is good news for the market. And investors, even economic bears like I tend to be, have to be market bears in the very near term in that circumstance.